Hi, this is Randy Finney with Right Side of the Chart, and today is October 24th, 2015. This video is a follow-up or part two to the video I did earlier today. In that video, I discussed really the long-term, the bigger picture on the U.S. stock markets, the long and intermediate term outlook, the reasoning why for months now I've had a bearish bias. Made that case again. If you haven't watched that video, you may want to, because that really it plays into my near term outlook. You know, on the near term, in this video, we'll really hone in on where the markets are probably going in the coming days to week. Long term, that video would be very helpful for, let's say, a long term investor, somebody managing a 401k. You know, if you're not an active trader, there were some great trend indicators, when to get long, when to get short, to catch the bulk of a trend. However, for an active trader, I might have a bearish or bullish outlook on the U.S. markets, but being early by just a few weeks or a few months, which is the case when you're looking at yearly and weekly and even monthly charts, by being early, just a couple weeks there, can make the difference of 10, 20, 30% or more. Usually much more than a trader can tolerate in losses and drawdowns and stops. So again, I use that to help formulate my longer term outlook, and then that helps me decide. Like, for example, when we start looking at the charts here, these 60-minute and daily charts that we'll get to in a second here, I can make a bullish and bearish case on that. I can do that at almost any point in time. I mean, give me a chart, and I can make a bullish or bearish case, but I have to act on it. If I always straddle the fence and say, well, the market can go up, the market can go down, or this stock can go up or down, I don't make any money because I don't pull the trigger. So my job is to formulate an opinion. Right now, I will say there were some bullish, considerably very bullish technical events that happened on Friday. I'm going to talk into that. But I also can see the potential for some very bearish, let's say, reversals of what happened on Friday next week. But that hasn't happened yet. So as such, as I've stated, I've been, maintained a bullish bias overall since the lows on August 24th when I flipped reverse from short to long. And at this point, I am getting interested in looking to reposition short. Those signals aren't here yet, but they can come as early as this week. So let's go ahead and dig into the charts. Before we get to the charts, let's talk about the Nasdaq 100. In those charts, and as I've mentioned in the past, the Nasdaq, particularly the Nasdaq 100, has been by far the leading index for not only the last few years, but also off the recent lows. Since we had that sharp sell-off leading into the August 24th lows, the Nasdaq 100 by far has led the advance. And that I'm going to speak to some things on that, and let's get into that real quick, why I'm focusing on that index. All right, so we're looking at, this is directly on Nasdaq.com, their website. This is the breakdowns, the top holdings of the NDX 100, or the top holdings of the QQQ, which tracks the NDX 100. What I wanted to highlight here, many of you who followed the site for a while know I always harp on how unbalanced the Nasdaq 100 or the QQQ is. The top 5 holdings, if you add these top 5 holdings up, that gives you a weighting of 32.37%. In other words, 1/3. So 1/3 of the performance of the leading index in the U.S. markets is attributed solely to 5 stocks. So if you know where these stocks are going, if you can get a good pulse on where these stocks are going, you have a good shot of knowing where the market's going. Take it further, if you look at the top 10 holdings, add those in, then you have a 47.13% weighting, so roughly half of the stocks in the Nasdaq 100, or roughly half of the performance of the Nasdaq 100 is attributed to just 10 stocks. So what we're going to do, we'll take a look at the charts on some of these, and there were some significant technical events. They were bullish on Friday. So I don't want to dismiss that, but I want to talk on what I'm looking for into next week, what may happen here. Before we leave this page, let's clear that. Let me just go down to the bottom. This chart, unfortunately, it won't refresh. I tried it today. If you try to click any of these settings, I wanted to just look at the last 3 months, but you get a default. It won't an error message. It won't load. So what it's showing you here is the last year within the top holdings, what they each did. So you can see up here, Amazon has been the big leader, up 80% year to date. Just very, very impressive returns on Amazon. So again, speaks to what the market's done. Apple is sort of, the biggest holding down here. I'd have to zoom in a little bit. It's hard to catch it. Somewhere right around there. Yeah, about so almost flat, but still up. Respectable. What is that? 8.5% year to date. So again, you can see how they all move together. And I'll tell you, with the Nasdaq 100 and the QQQ, a lot like GDX with the gold miners. I think it's a case of the tail wagging the dog in a lot of instances. In other words, yes, stocks over the long run undoubtedly go. The fundamentals drive where a stock is will go in the long run. However, in the short term, and this short term can be days, weeks, even months. I believe a lot of times, or actually I know a lot of times, it is driven not by fundamentals but by money flows. And the QQQ is one of the most widely held ETFs, and there's also mutual funds that track the Nasdaq 100. And of course, these stocks here are the most widely held stocks in the world. So what happens when you have a panic sell-off like you did recently, heading into the August 24th lows? The selling from individual and institutional investors dumping those stocks leads to more selling, because the fund companies have to meet those redemptions. If somebody says, give me my $50,000 of QQQ back, I just placed an order to sell with my broker, that they have 3 days, T+3, trade plus 3 business days to get that money to you in cash. So they have to sell Apple, Microsoft, Google. These must be sold. So anyways, that's just how the market works, and why I'm watching this, because once we see these leaders break, that will most likely indicate that a new bear market is underway, because at the final stage of most bull markets, you have it's fewer and fewer stocks lifting the market. And I'm going to make that point right now, and really I've been making that point, I should say, for a good year now, showing you divergences on the, for example, the percent of stocks above their 200-day moving average and other metrics like that. But now let's take a look at what's happened since the July or August 24th lows. This is a 60-minute chart, hourly chart of the NDX, and what I'm doing is just using closing values. I put a line chart up to keep it simple, and I wanted to measure that out. So what I'll do is capture this. If I click on the October 24th low here, and move up to where we are today, or I'm sorry, where we closed yesterday on Friday, 4 p.m., that shows me a gain. If you look at the box on the left-hand side, the white box, and the green letters towards the bottom, percentage terms, is 15.54. Okay, so it's a 15.5% gain on the Nasdaq. Now let's take a look at a couple other things. This will speak again to the underlying internals, or the breadth and the health of this market. That's the Nasdaq 100, which I just illustrated how heavily weighted it is in the top 10, especially the top 5 components. This is the NDXE, the equal weighted Nasdaq 100. And let's see what that's done since the 24th. So we go here to the close, 11.4%. So that's a difference, or 11.5%. I haven't calculated, but that's an extra 4%. What is that? Got to be better than 30% difference. In other words, the NDX outperformed the NDXE by at least 30%. I haven't pulled out a calculator, but you can do that rough number. And let's take a look at the composite. The Nasdaq composite has all of the stocks in the NDX 100, plus a lot of the smaller companies within the Nasdaq that are listed on the Nasdaq composite. And what have we done there? We've rallied right at about 12%. So it's really about the same story. Now let's look at a few other major indices. Here's S&P 500. This is a very, all large caps, big name, so it should have done well. Not bad, but only 11.35. So you get the point. So far, the bulk of this rally has been attributed to, and keep in mind, the S&P 500, many of their top components, such as Apple, are also the top components, in the NDX. So now, what did I say? Well, let me look at this one more time. The 24th, we did actually the S&P. It bottomed on the 25th, so I'll just use that number. I'll use it from the 25th, and that gives me 11.3. And what I wanted to do is now look at the S&P equal weighted, or the SPEW. This is an equal weighted index of the S&P 500. And so from the lows there, we went up 9%, 9.1 versus 11%. So that's a difference of an extra 20% or better. In other words, the S&P, because of that heavy weighting to some of the bigger, larger names, increased by an extra 20% above the equal weighted S&P, which shows you that those lower tier stocks are not participating in this rally, and that speaks to the underlying health if you lift up and look under the hood. Finally, let's look at the small cap stocks. Here's the Russell 2000. I'm going to go off the lows on the 25th. It did make another low from that point, but this is an apples-to-apples comparison from when the majority of the U.S. indices bottomed, and we only have a gain of under 6% into Friday's highs, so 5.86. So that is nearly a third of what the Index 100 did. So again, my focus here, let's look at the stocks in the NDX 100, because if we know where those leading stocks are going, then we have a good idea where the market's going. So what I'll do here is pull up the NDX. It's the NDX. This chart is a little bit busy right now. Don't worry about this chart. What I'll show you here is the top components. So this is a listing of all the components in the NDX 100, a watch list that I have. I've sorted it by market cap. As you can see here, Apple's the largest. It is the top holding in there, and of course it's the largest market cap. That's why it's the biggest holding. So it's about 660 billion. And what I'll do is I'll just take a look at some of the top holdings. We won't look at them all, and this will determine, I think, what happens next week will be very important. We're looking at Apple here on a daily chart. And here, this was a former support zone. These lines I had here, there was a big support shelf at which Apple traded throughout almost all of 2015 until it finally broke down and the selling kicked in. Now we're back testing. Look at that. I have not modified these trend lines. You can see that one was last updated in July, and haven't even touched it since then, and now we're back testing that. So that is a major resistance zone, because it was a major support zone that contained this trading range throughout most of 2015. And once prices broke down, to further validate how important that support zone, you can see Apple had a sharp meltdown, came to back test it once, kissed it from below, and that was it. And now we're there again. So there's Apple at key resistance on the daily chart. Let's just take a look at the 60-minute chart. I don't have anything marked up here. I have a lot of different boards. I don't see anything more really to go over on Apple. I've made the case, probably the bigger picture on Apple should be talked about. This case has been made since Apple topped back in April 28th, put in a bearish engulfing candlestick. And all along the way, I've done analysis on Apple, this trend line break and the 40-week moving average, and I made a case for years. I've made a case that has defined and would define the next bear market in Apple once that 40-week and this uptrend line went. So in my book, well, not in my book, it's already dropped 32% off the highs, so that's clearly a bear market and then some. But I think it's in a larger secular bear market, and this is just a counter trend bounce. How high do we go? Well, let's see. Like I said, next week will determine a lot if we can get by that level. All right, Google. I'm going to go to, that's Google Class A. I think I have a chart marked up here on, the other one. The charts are identical as far as the candlesticks and all that. Here's what happened. Friday was just a very technically significant day for a lot of these big leading tech stocks, some of the leaders in the NDX 100, the top 5 and top 10. Google is one of them. You can see here we had, this is a daily chart we're looking at, 1, 2, 3, 4 candlesticks, 4 attempts to get over this 676 roughly level. Another failed attempt there. That became very significant resistance. Then we had the earnings. I believe it was earnings that popped this stock on Friday. Big day for Google. And so on face value, let me be very clear, you can't take anything bearish from that. That is nothing but bullish price action. Gap above, breakout to new multi-year highs. Anytime a stock makes new highs, I mean, this is a new all-time high. Anytime that happens, that's a bullish technical event, because you have every single buyer in the stock at that point is profitable. Nobody is underwater. That's why a 52-week low in a stock is bearish. There's so much supply and pent-up sellers in the stock. So I won't talk on it too much. Now, here's what I'm looking for. And there's a few other stocks that had these big gaps like this on Monday, and I'll talk on Friday. What I think may happen and what I'm on the lookout for is one possibility, which I would love to see, because I would be able to get aggressively short with minimal downside risk, and that would be to see an island or an island top or an island cluster reversal. Now, what an island top is, or an island reversal, this candlestick right now is all by itself up here. Now, let's say on Monday we gap down below the bottom of the $700 level, below Friday's lows. That would then leave, that would be called an island top. There'd be a gap down here. As long as prices don't get back above there by the end of the day, they don't backfill that gap. It's not uncommon to see another few days, let's say on Monday, Google continues, they open up around this level, trade higher, lower, somewhere in that range. That happens for a few days. There's a few more candlesticks, and then a gap down below. That would be an island cluster. And an island cluster reversal top would come on a gap below the bottom of the range of any candlesticks there that might happen for the next few days or even a couple weeks. Usually you don't see them more than about a week's worth of candlesticks. Those are some of my favorite patterns, because if that does happen, I would typically wait for some confirmation. I can tell you right now I wouldn't be all in short on a gap down, because you still have the potential for Google and a lot of these stocks that had that big breakout. They may want to come back and do a backfill this gap. For example, here's the recent highs. They can hit that level, bounce off. I would actually lean more towards a backfill of the gap. Let me just put a horizontal line here. So there's a gap right there. This is the bottom of the gap that occurred on Friday from, right here. So let's say, draw that out. So one possible scenario for the bulls that might get the bears a little excited would be to see Google go down there, even if it did gap down, and then reverse, fill that gap, and then take off. Possible, absolutely. That's why on a gap down, I would be a shorting, and I might, and again, I'm taking this in context with all of the Qs. I might just short the Qs or something like TQQQ, with then stops placed right above, just slightly above Friday's lows on Google, because that would then invalidate that island reversal top. Now, there's many other types of bearish candlestick reversal patterns that can happen, so I'm on the lookout for any of those. But what happened on Friday, besides the fact that we had that big bullish gap up, look at the divergence. Prices made a higher high, as I drew out this trend line from these previous highs over here, against both the MACD, the RSI, just about any indicator or oscillator that you look at, making lower highs. In other words, those are strong potential divergences. So should Google turn back down, as well as some of these other stocks, let's take a look at Amazon. Amazon's almost an identical story. It had boom, 1, 2 test at this level. Those were the all-time highs, and then boom, on Friday, a big, nice, fat gap above there. But if you look at the bigger picture, or I should say the glass half full, a bull's going to see that as, hey, break out to new all-time highs. That's it. It doesn't get any better than that, and that may be the case. But I'm looking at this bearish rising wedge. Personally, I don't chase breakouts, even if they're to new highs, when I see strong negative divergences in place, especially below when prices are at the top of this bearish rising wedge. If you take this trend line here that connects the highs, that really highlights these divergences, you have this trend line off the lows. I would be more apt to short here with a stop not too far above. Not going to do that yet, I'd like to see this gap backfilled and then lost. Prices move back below. And I'll tell you, if I were to short Amazon individually, my all-in would be a break below this trend line, especially if it followed some type of bearish candlestick reversal pattern here after that gap up sometime in the next week or so. And if Amazon falls, if Google falls, Microsoft, there go the cues, there goes the market. All right, so let's look at Intel. Nothing much on Intel, really. It's sort of near-term bearish, bullish price action. Facebook, look at this trend line here, very steep. If you just look at this line here and this one here, you have this sort of like a triangle pattern wedging up. It also had, again, these are the top components. As I said, they tend to trade together. So much of these stocks have been in sync in the last couple of years. And there was Facebook had numerous attempts to try to get above that 99.20-ish level, finally broke out, put a little doji type candlestick in on Friday. So again, I'm on the lookout for some bearish confirmation. And even if prices continue to build, go higher, for the time being, they're going to have to do so without me. I'm not going to chase that on the long side. I'm not adding short just yet. I should take that back. I did put a little short exposure on Friday, but on individual stocks, not on Facebook. There's some negative divergence. Now we have the potential for this divergence to be burned out. It's still also what I call potential divergence. See the MACD pointing up? I want to see this MACD turn down, the blue line. I want to see that curl down, cross over, and start moving lower before the MACD makes a higher high. If the MACD moves up here, makes a higher high, then it has burned through or negated that negative divergence, if you will. So that's it. Right now, that's what I'm looking at. And you can see with Facebook, I mean, it easily has a potential in the next week or so. If it comes back here, it can't hold those previous, that what was resistance and now should be support around 99. Give it a little room, 1%. You don't have to, those lines shouldn't be exact levels, especially on an intraday basis. It means don't go shorting if it drops below 99.20, thinking the stock's going to fall. But if it closes below that line and this uptrend line, especially by a fair amount, I would say that that's probably it for Facebook, that this would be a major bull trap, these new high breakouts in Facebook and Google and Amazon and everything else I've just mentioned. All right, I won't go through all of them, but that's what I'm seeing. These are some of the key stocks. I just went over Apple, Google, Facebook, Amazon. So this is why I think next week has the potential to really do some technical damage to the charts to help the bearish case, but it also has the potential to really continue to chip away at the bearish case if these guys can continue to build on these gains. And it might take a couple weeks, because even if they don't just move straight up from here after Friday's big move, they may want to come back. It would only be natural to see them want to come back and back test those recent the resistance levels, those tops, in this case a triple top in Facebook, as well as this uptrend line here. So again, what I want, if there is an all clear or all in short entry on the cues, to me it would be prices moving solidly below these levels, these recent highs that they just broke out of, especially those that gapped up to new highs yesterday, and to see those prices come back down here. I'd love to see a big fat red candlestick. Maybe we even pop up higher on Monday and then a bearish engulfing candlestick, red candlestick that covers the span of this doji, and then a move down through there the next day or that day below these trend lines. Ooh, that would be a beautiful swing short entry. I'm not talking just a quick move down to any of these levels. I'm talking to put back on some shorts for the next leg down. Okay, this has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.